You guys came to the right place at the right time. Congratulations. We're about to have some fun. This is Ask the Experts. So you're going to find a ton of questions in this presentation, and these questions come from the market. We ask the market what's important to you, what's on your minds, what's really something you're hoping to get some insights on. And so we brought the best of the best to have that conversation with you. And so let me go ahead and introduce the panel here. My name is Alex Kutsishin, co-founder and chief visionary officer here at Sales Boomerang. With me, we have David Savage, which again needs no introduction, but here he is. Dave, say hello.
Hey everybody, and by the way, it's Dave Savage.
Did I say Dave? Did I say something else?
What did I say? You called me David, but that's okay.
Oh, I don't even realize I said that. Dave Savage, that's right. Who's David? I don't even know who that person is. We also have Dr. Mike Frantoni here with us, chief economist at Mortgage Bankers Association. Mike, thanks for joining us.
Thanks for having me, Alex.
And yet another person, actually the rest of these folks, nobody needs introductions, but we will. Rob Chrisman is here. Rob, thanks for joining us.
You're welcome.
And of course, Owen Lee, co-owner and corporate counsel at Success Mortgage Partners. Thank you all for being here. This is going to be super fun. Yes.
Alex, you said ask the experts panel. I immediately thought I logged into the wrong Zoom, but I'll do my best.
Do your best. Do your best. If you need support, just let us know. So look, guys, as we always like to do, first of all, we want your engagement. So go ahead and write things into chat, ask questions, because remember, this is all about Ask the Experts. So not just the questions you see on screen, but anything that also comes to mind, make sure you guys are asking. And I'm going to be handing this off to Rob to lead the rest of this conversation. We'll all be chiming in and helping out, but we're starting with a poll. I'll introduce the poll, Rob, and then it's off to you to manage the rest. What are the most common economic concerns you've heard from consumers recently? High home prices, inflation is making it hard to save, high rates raising the cost of borrowing, anxious about potential housing stock market crash, or all of the above. Let's see where you guys land. We'll give this 60 seconds while I hand this off to Rob.
Thank you, Alex. Yeah, let's see what the economic concerns are, because for a long time, it seemed like the economy was almost a second thought, especially during 2020 and 2021 with the pandemic. Of course, the pandemic and its influence on the economy impacted our industry quite a bit, but the dominant factors or the dominant theme that I saw during those couple of years was how can we hire fast enough? How can we help our borrowers? We're drinking from a fire hose. What are we going to do here? Where do we go from here? It wasn't so much the economy as it was, how are we going to help the millions of borrowers out there refinance or find a home? But now you're right. The focus has definitely shifted onto the economy. And I like to say predicting the economy, it's like trying to predict the future, but I know Mike has some very interesting thoughts on where we've been and where we're going to go. And I want to see the result of this poll. So how does,
there we go.
Oh, there we go. All of the above. And then high rates, cost of borrowing. All right. Very good. So all of the above.
It seems like everything, all of those things are on people's minds and concerns that they're hearing from their customers. It's not one thing overtaking another. It seems like all of this is being heard.
Yeah. And I would echo that sentiment, just given the emails that I receive on a daily basis about different topics. But who am I to say anything really when we've got Mike on the call here? And Mike, so many of the people I think on the call, so many people in the industry look to you and look to the MBA for forecasts, not only necessarily to drive their business, but just to give them some kind of inkling in terms of where we might go and why we might go there. I know you're very good at explaining both. So I'm going to let you take it away here for the next 5 or 10 minutes and go through some of these slides.
All right, Rob, thank you. And
you caught me at a good time. We just rolled out our July forecast this week. So these are late breaking numbers. Again, as Alex was mentioning, this is a wild time to be trying to forecast what's going on in the broader economy and mortgage markets. But here's our latest thinking. So as Rob mentioned, the last couple of years, it was all about recovering from the pandemic. So you see that 5.5% growth in 2021. This is one of the strongest rebounds we've ever seen in the United States. We're at an inflection point now where the economy is definitely beginning to slow. You see our forecast for 2022 now has a 0 in front of it, right? So about 0.6% growth for the full year. And then the next couple of years, 1.5%. So that's closer to trend growth after this, again, amazing recovery. I think to the poll results, I would completely agree. You look at some of the consumer sentiment surveys that are out there, people are just worried, right? You see the stock market crash, inflation at a 40-year high, and concerns about where we're headed. What is this slowdown going to mean in tangible terms? If you look at that unemployment line, while inflation's at a 40-year high, and that's certainly a negative, the job market today, right now, is probably as strong as it's been in 50 years. We still have more than 11 million job openings. The unemployment rate's at 3.6%. We've been averaging almost 400,000 gain in employment per month. But you can see from this picture, with the slower overall growth, we think the unemployment rate's going to rise. So we'll be above 4% in 2023 and 4.5% in 2024. Not a bad number, but not the 50-year strength that we're seeing right now. What's causing that? Well, primarily it is central banks around the world, including the Federal Reserve, acting to try to slow that inflation number. So I mentioned we're at a 40-year high. The most recent monthly number was at 9.1%. We think we'll still be at 6% by the end of the year. That 6% is a Q4 number. And we're not going to get back to the Fed's target of 2% until 2024, even with them hiking short rates as aggressively as they are. So you see that Fed funds line right now, Fed funds target is call it 1.5 to 1.75. I think they'll do 75 basis points next week, another 50 in September. Keep pushing rates above 3% by the end of this year, and we'll be getting close to 4% in terms of that Fed funds target in 2023. This is all in an effort to try to bring down inflation back to their 2% target. Now, if you look at our forecast for longer-term rates, and if we could go on to the next slide, this is probably better in a picture.
Sure. Real quick question, Mike. There's somebody.
Yeah, I got.
Go ahead.
Go ahead, Alex. I've got a question probably after yours, though.
Oh, there's a question that went into the Q&A section, and please keep putting those questions in there, guys. Aaron is wondering, what is a normal unemployment rate?
So if you ask folks who run the Federal Open Market Committee, and their opinions matter, 4% is closer to average, right? So we're below the long-term sustainable level of unemployment right now. So some of that increase is getting back to normal, but we think we'll actually go beyond that. Rob, you want to take? You had a question for me as well?
Yeah, Alex, we can go back a slide.
Sure.
I actually wanted to ask Owen. You're running a mortgage bank, an independent mortgage bank, and so you're looking at this, thinking, all right, what am I going to do if this plays out as Mike is talking about, is forecasting here? How do I position myself? And I know we're going to talk about this later in the session, but just looking at these numbers with 30-year mortgages, in the 5s, and then hopefully dipping a little bit next year and the year after. What are you doing? How do you act or react to this?
Great question.
So when I look at 2022, and I would actually had a similar question for Mike. We saw rates touch the 6s, I think 2 or 3 weeks ago. We had a week where the bond market had 3 100 basis point intraday moves. I can't remember. I've been in the industry for 20 years. I can't remember the last time that's happened or if it's ever happened. And, we get these herky-jerky moves, which have almost become normal now. But so if we're thinking that, rates when they touch 6 or got a little bit above 6, depending on if you factor in points and whatnot, if they're going to moderate down to 5.2, then if I'm running, our mortgage bank, I think, okay, we're cresting at the worst of it right now, right? We're cresting at the worst of home buyers, especially first-time home buyers, just getting scared by the interest rates. And when people don't know what to do, they tend to do nothing. They shelter in place, right? So if we're going to stay up in the high 5s and the 6s, I think we're in for a rough ride the last 6 months. If things moderate and start to come down and, we lose another 50, 60 basis points in the rate and end the year at 5.2, then, we're weathering the worst of it right now, and hopefully the seas, the last bit of the summer and the fall will be a bit calmer, than they have been in May, June, and July.
Yeah, that's the right way to think about it, I think, Owen. If we go to the next slide, again, that's the picture of what you're talking about in terms of the rate forecast. So the red line's the mortgage rate. We do think we're at the peak now, and the volatility you talked about obviously driving up mortgage spreads beyond what we've seen historically. So much as the Fed can get a clear message out there with respect to their future path, I think some of that volatility will calm down and that mortgage to treasury spread may come in a bit. So that's part of what's driving that rate down. The other thing I'll highlight here, the blue line is the Fed funds target. So they are going to keep pushing that, like I said, up to almost 4% by the middle of next year before they'll start to come back down to sort of 2.5, which is their neutral point. But what this is showing is we're in an inverted yield curve environment now, and I think we're going to stay there for a substantial period of time, next 12, 18 months or so. And I think everyone on this call knows inverted yield curve is a tough environment for financial institutions, whether you're a bank or an independent mortgage bank. It's just going to really, there's a lot of friction in the system, a lot of additional costs. Last thing I'll say that I definitely want to get feedback here. The other thing that's driving this rate path is that there's two really scenarios you have to have in mind. One is the one I showed you on the prior page, which is our baseline. But honestly, I think it's a coin flip right now between that forecast, which is our baseline, call that a soft landing, versus a recession. What would a recession look like? I think a recession would happen in the first half of 2023. Instead of the unemployment rate peaking above 4%, we'd get up to like 5.5% and get there fairly quickly. You'd have negative growth in that first half, and you'd see rates coming down faster than what I'm showing here. We're not going to get back to a 2.5% mortgage rate. I don't see really any scenario where that happens over the next couple of years. But you'd see lower rates than what we're showing here in our baseline. So I think to Rob, your question to Owen, if I were running a mortgage company, I'd have both of those scenarios in sight, right? One, sort of that soft landing, the other, recession. That has real implications both for the rate path, but also, your origination and your servicing business. You might see delinquencies go much higher in a recession than in the baseline. You also might see different level of confidence from your potential home buyers if we really truly enter a recession. So,
yep.
And curious about your feedback.
Hey, Mike, can I ask you one question about that? One of the things that I've noticed lately with the financial markets is, and this is I took one economics class in college. I won't tell you what my grade was, but I took one. And, things used to be based on fundamentals. Right now, because of the 24-hour news cycle, I don't feel like anything's based on fundamentals anymore. It's based upon where people think the fundamentals might be 6 months from now or something like that. What about the elections in November? If it goes one way or it goes another way, if it goes an unexpected way, do you think it has the possibility of throwing a wrench in what most people are predicting for the markets?
Great question. As you know, better question from my colleague Bill Kilmer with respect to where elections are headed. But My take, this is a midterm, right? So the biggest change we could get is moving from essentially an evenly divided Congress where Democrats have the majority to divided government. So go from a place where very little is getting done in Congress to almost nothing's getting done in Congress, right? So I don't see a huge swing with this election. Obviously, 2024, much bigger potential for change there.
Hey, Mike,
So,
if we go back, I don't know, Alex, if
You want me
we
to show
go
the
back to
screen
that
again?
first slide,
yep.
one of the questions was right now inflation is up at 8 or 9%, 9.1 or whatever it might be.
Yeah.
And you are predicting inflation for the year at 6%. So
That's ending the year at 6%.
oh, so these are so you expect by the end of the year, not the average for 2022, but at the end of the year, inflation will be at the consumer level will be about 6%.
That's right. The year-on-year inflation number by Q4 will be down to 6%. It was 9.1% in June.
Okay. All right. Thank you.
Perfect. And I know there's some other questions, Rob, if you want to get to them when you want to get to them. Keep them coming, guys. There's some good stuff, good questions, and we'll address them.
Yeah, so let's translate this to what I think it means for origination volume. So as everyone knows, we just came off the two best years ever, $4 trillion plus for both years. We're revising our 21 number now that the HMDA data is out. Call it a 40% decline in volume full year 2022 compared to 21. Most of that coming from now almost a 70% drop in refi volume. You look at our most recent weekly application survey, refi apps are down 80% compared to where they were last year at this time. We're at a place now where,
from lenders too, by the way, about that 80% number. Yeah.
Yeah. Then on the purchase side, essentially flat in dollars, but because home prices have been growing so quickly until very, very recently, on a unit basis, that number is down quite a bit. So with this July forecast, we revised down our forecast for home sales for the year. So previously we were showing existing home sales down about 6% for the year. Now we think they'll be down about 8% for the year. So you look at total mortgage origination volume, we're a little less than 2.4 trillion, and we think we'll be at 2.2 trillion next year. Really what that's saying is think about the pace of originations you have right now, sort of extend that all the way through 2023. We just had some spillover volume from 21 in the first quarter of 2022. And then if you look at our forecast for 2024, in the neighborhood of 2.5 trillion. So our expectation, unless you get something really far off of those two scenarios that I discussed, is that sort of this is the level of activity to expect, much more purchase dominated. If we do go, if we get tails on that coin flip, we get that recession path, the refi number in 2023, maybe a couple $100 billion higher. But again, I don't expect the rate swing to be enough to get us anything close to what we had in 2020 or 21. And then my last slide, and then let's just open it up for discussion. What does that mean for mortgage lenders? So if we go forward one more.
Yep. Let me just clear let me clear this out, and then I'll go forward.
Okay, thanks.
Yep.
Hey, Mike.
Sure. Just let me share this real quick. So in terms of profitability, so this is from our quarterly performance report, looking at net production income, all your revenues minus fully loaded costs, and this is in basis points of production. You go back to 2008, that averaged about 55 basis points, almost 1,300 per loan. We hit a peak in third quarter of 2020 at 203. First quarter of 2022, we were at 5 basis points, so looking much more similar to what we saw in 2018. And all my conversations with lenders, we're looking for something less than 5 in second quarter, and you'll see that number from us in mid-August. So
wow.
Rob, those are the numbers I wanted to lay out, but definitely want to get the color from Owen and you and Dave and Alex, and what can you tell me? What does this mean in terms of how lenders are operating?
I have a question here, and I want to give it to Owen because this is really enlightening. And one of the biggest takeaways from our halftime report, and I interviewed Rob for that and Owen for that, was that lenders need to do a better job of not just measuring how many loans do we close, what our volume is, but really start measuring conversion and profitability for loans. So Owen, is there anything you're doing different in this market right now when it comes to benchmarking, measuring either conversion or profitability per loan officer? Would love to know what that is. And then Michael, I want to, after he answers it, hear if you're here, if you have any recommendations for the industry so that we could do better at this.
Well, I think, thank you, Dave. I think what we've done differently is much more back to basics. And what I mean by that is, if you are a student of Mike's predictions and the MBA metrics, you know that 2018 was a fairly skinny year. First quarter of 2019 was terrible. And then the interest rates started to moderate down and people started to get busier. So really from about July 1st, 2019, and then the pandemic, I mean, you were just expanding. If you had a loan officer or an underwriter or a processor and they weren't quite hitting the metric and you wanted them to do 20 widgets a month and they would only do 16, you would keep that person and let them do the 16, because where are you going to get somebody else to do the 16, right? You needed that 16, even if it wasn't the metric that you wanted. In 2022, that's not the case. Really starting in the fourth quarter of 2021, you could feel the slowdown coming. And so it's really getting back to daily metric management, right? How many, we get reports, all my senior managers in the inbox, what were the apps, what were the, total dollar volume, but more importantly, what do we expect the conversion to be? What are our locks? How are we pricing as it relates to where we should lock? What are our concessions? What are our concessions per loan officer? We're looking at all of those things because they all add up into the whole. So as you and I shared when we talked, Dave, last week, we're a big user of Microsoft Power BI to measure that, and we can break those things down by individual branch and individual loan officer, because it's really getting back to the basics. And for 3 years almost, we were in a market where it was just how many loans can we push across the finish line. And 2022 is the opposite of that. And, I would and Dave, we also talked about this, but I think we're going to need some pretty calm seas in order to get to those projections the second half of the year. I think interest rates are going to have to moderate back down towards 5, because some of the things I've been seeing the last 6 to 8 weeks for originations, if that doesn't calm down, we're going to have a rougher 6 months. I think those final numbers are going to come in a touch lower than what's predicted.
So one of the questions that came up, Owen, probably hate to keep throwing questions your way, but Joe mentioned an economic concern whereby, we can sit here and talk about interest rates, and we could talk about loan level price adjustments, and we could talk about inflation, et cetera. But when you're an underwriter or you're a loan officer or an originator, and you are dealing with some of the disaster related issues that we as an industry face in terms of earthquakes and fires and flooding and so forth, and the weight of the insurance burden on the family or the individual or the person trying to qualify for a loan, or lenders who are dealing with FEMA issues and collateral that's being damaged out there for whatever reason. How are you reacting as a company to the whether it's the flooding or the wildfires in the West, in terms of the impact on borrowers? Or is there really anything you can do other than just be cognizant of it?
Great question.
I don't think there's a whole lot you can do. Honestly, we're an IMB, so we close loans and we have a certain amount of time that we have to sell them. And if we take longer than that time, we've got our warehouse banks tapping us on the shoulder, asking us very politely, of course, what are we going to do about these draws? But when you look at the disasters, what I really see, and we're mostly Midwest, East Coast, and Southeast is our footprint. So we don't deal with a lot of the wildfires and whatnot. It's mostly the Midwest is pretty calm, occasional tornado or hurricanes in the Southeast is our big thing. But, when FEMA declares those disaster areas in counties, secondary mortgage participants are very, they pay a lot of attention to that. So you have to get appraisals redone before they'll buy loans or get drive-bys to make sure the house wasn't affected. There's not a lot that you can do, for the individual borrower in that scenario, other than, we have to make sure that your property and your collateral is what we all think it is before we can close and move your loan through the pipeline, really from origination to final sale.
Hey,
Yeah.
Rob, you are raising a really, really important point that I'm hearing from a lot of Gulf Coast lenders, where they're saying that affordability is not just about the principal and interest and the home price and where mortgage rate, but they're seeing homeowners insurance rates, go up 2-3 times from one year to the next, and really pinching a borrower's ability to afford that payment. So it's something I'm hearing more and more.
Yeah, and whether for better or for worse, I send the commentary out, and I receive a lot of emails, no matter what's going on. And every time I mention climate change, I receive plenty of emails agreeing with what's going on, and plenty of emails saying there's no climate change. But to those emails, I respond, climate change or no climate change, the investor community and the insurance community, they believe that the climate is changing, and they will price accordingly. And whether you believe in it or not, it impacts the prices that your borrowers pay, whether it's insurance or whether it is flood or rising sea levels. And investors want to protect their collateral. So whether or not you believe in it or not, if you have investors who believe in it and they're going to not price things the same based on where that house is compared to, say, sea level, then it starts to matter. And you do have to include it in your business model. You have to include it in your pricing. And I think it's not as if this issue is going away. In fact, it's front and center now more than ever. So, but that's that, Mike, by the way, that Alex, if you go back a slide to Mike's profit there, it is important. I remind people to keep things in perspective, and it is important to see that, we are coming off a real sugar high in the last 2 years, 2020, 2021, which nobody expected to have happen. And the volumes and profits were unheard of. If you go back historically, as an industry for independent mortgage banks have not always made money. And it's important to remember that. And we go through cycles. We're a very cyclical industry. So I know there's a lot of hand wringing that's going on out there right now, but I think the seasoned vets that I speak to or speak with pretty much agree. Okay, we're in a cyclical business, and the last few years have been great. We're going to go through a downtime here, but it'll come back one way or the other. The question is staying nimble, and I know Alex, you and Dave do a great job in terms of being able to keep companies and keep originators nimble in terms of dealing with their clients and clients retention. Absolutely. And knowing what to do. And I think, Dave, I want to ask you now, before we go to that next slide, what are you seeing originators do different than, say, they were doing a couple of years ago? Or is it the same discussion that you're having regardless of business cycle?
No, it's absolutely the loan officers that have the best conversion that are the most profitable, that have the least price exceptions, and who are also gaining market share are absolutely delivering a different experience. So in previous years, first of all, consumers, when they heard about the interest rate, they weren't pissed, scared, or surprised. When people hear about rates now at a consumer level, they're all of those things. They're surprised, they're concerned, there's fear. It's not a happy moment. So they're shopping. Even if they ever Googled mortgage or they said real estate out loud in their house, they're going to be getting rates. So that everybody is omni shopping. And so two things that I see the most successful loan officers do. First, they're giving the family options. And those are ranging from 0 points. And usually it was like a point to a point and a half. So like a point, 0 points, a point, 2 points. But I'm hearing loan officers that like at the TBD, as they're pre-qualifying someone, showing them different rates on up to 2.5 points. And so that's different. That was not happening. And it's value from a consumer standpoint. It's better because they're getting more transparency. They're getting more options. And then the other thing that's trending a lot in the mortgage coach community, our Facebook group, is seller funded buy downs. So for example, there was a house that was listed for $700,000. This is a story I heard 2 weeks ago. And the buying agent wanted to make a $620 offer, I think. And the listing agent said, don't bother. We know it's not going to sell full price, but we won't even counter that. And the loan officer got creative. He said, hey, what if I got a seller funded 3-point buy down, 2 points to buy down the rate, 1 point to go towards cash to close. And they came to compromise. So you're seeing a lot of seller funded buy downs. You're seeing a lot of 2-1 buy downs. And then you're seeing a lot of options with points. So those are probably the most prolific changes. And then one last thing is they're taking that story and that strategy to realtors. So the best loan officers aren't just saying, hey, I can close a loan on time and I have competitive rates. They can say, hey, I can help you with creative strategies to help you sell your listings. Or I can help create strategies to help you maybe not make a full price reduction or make a partial reduction. So they're partnering with realtors in creative and smart ways. And of course, they're using our mortgage coach total cost analysis, and they're using our borrower intelligence with Boomerang.
Very good. Owen, go ahead.
Yeah, no, I was just going to say, if I could add a common theme to what Dave just said succinctly, they're leading with education.
Yes.
When people don't know what to do, they, as Mike had pointed out before, they tend to do nothing, right? They shelter in place. And some of us who are a bit longer in the tooth in this industry look at a 5.75 interest rate and say, that's not high. What are you talking about? My first mortgage was at 8.875, and I was damn happy. I did a jig outside the closing because I got below 9. So it's all relative. But to lead with education, not just to the borrower, but also to the realtor, to say, hey, let me educate you about why we're doing this for the borrower, how this is going to work for them, and also work for the seller. It's a much different tactic than what we might, last year it was just, how do I get this guy to be able to offer $50,000 over the ask price? Otherwise, we're never going to get it. It's totally different, but very valid for what's going on in the marketplace today. And, I don't want to sound like a big commercial for Dave's product, but our mortgage coach users are amongst the highest converting loan officers in our company. But what that really means is they lead with education, and that creates a comfort level that helps people move forward.
No hey, Rob, can I say one more thing on the heels of that? Is for every mortgage leader on this, there is a financial literacy crisis in America. That is just that. And the mortgage industry is so well positioned to really make a dent in that. And one thing I would advocate, especially in this market, is every first-time home buyer should get more than a pre-approval. Like, it's not how much you qualify for. They should get a rent versus own analysis. I mean, we make that easy at Mortgage Coach, but you can do it with an Excel spreadsheet. There's a lot of ways of doing it. But it's important that we help consumers understand the benefits of going from renting to owning. Move-up buyers, don't just pre-qualify them to move up. Show them a move-up analysis. It's important that we show consumers, not only do we give them a rate quote, not only do we give them a pre-approval, but we give them a little financial literacy. And if we did that, it would be millions of families served with education. So just to advocate, education is the way to win.
Yeah. Hey, Rob, just sort of the economist's thought on it, right? I mean, there are three ways lenders can compete: pricing, products, service. So the margin chart I just showed, pricing is not really a way to compete right now. There's not much lower to go. Products, people are introducing some ARMs. You know, the ARM share is up to 10% from 3% last year. So a little bit of that. But what you guys are talking about, you're going to have to compete on service, and you certainly got lots of ways to do that. But that seems to be the market we're in.
Yeah, and advice and education is the best service that a loan officer can deliver. I mean, it's table stakes to close a loan fast. You know, that's loan manufacturing, and you got to be great. But to give a little education, a little advice, will really go a long way when it comes to service in this market.
And I think it's very important to understand exactly what you're talking about, Owen, exactly what Dave was just mentioning. It's important in this environment, unlike 2020 and 21, that you have every possible conversation with a relevant borrower, okay? Every one of them. Don't ignore them. Do not pick up the phone. Do not call people back. Do not try to analyze and try to figure out if this is going to be a deal that happens now or happens tomorrow. Do not prevent yourself from having a valuable conversation with a borrower. They need to hear from you. It's relevant. Have conversations and make sure that you're listening to the consumer, right? And not forcing them into a loan, but listening to them first. And of course, then following it up with that education. But don't skip out on a conversation because you might think for a minute they may not be a customer for you right now. Don't do that, okay? All right, let's get into this, Rob.
Well, not quite done, Alex.
Oh, all right. Okay.
Dave talked about financial literacy, which is near and dear to my heart. And I would imagine that, Mike, you address a lot of audiences where you are asked, how do we improve financial literacy? You have a PhD in economics, obviously that's a great education, but just in terms of educating, I'm not going to go into high schoolers or junior high schoolers, mm-hmm. but do you ever engage in conversations about education in terms of borrowers and how loan officers and companies can help that process?
Yeah, I mean, I'll make a pitch. We have our Research Institute for Housing America, which puts out a number of white papers. Go to housingamerica.org. All those papers are available for free to anyone. And we did one looking at counseling and financial education a few years ago. And what it found that it can be really, really effective at teaching people the process of applying for a mortgage. It can be really, really effective at some very specific tasks. Sometimes I think we ask too much of it in terms of, it takes a lifetime to get good at budgeting and, overall sort of financial management. And you can't expect a 2-hour class is going to solve that for someone. But with respect to our purposes, getting someone familiar with the mortgage market and how to apply for a loan, the counseling can be very, very effective. So I would point people to that study.
Hey, real quick, I'm going to put a link down below because we've been pushing loan officers, and I've got $100 million producers that are going out and they're partnering with realtors, with financial planners, and they're going to high schools and colleges, and they're providing 30-minute financial literacy training. I'm going to put a link in chat to a video of a loan officer who's a $100 million producer, and he monthly goes to high schools and colleges. He's making his community more financially literate. And you know what? He's getting loans. He's getting loans from parents. He's getting loans from teachers. So I just want to remind everybody, guys, if we spread that message and we get ahead of compliance, like we don't have to do a rent versus own analysis. You don't have to give financial literacy, but if you do that, we'll be helping with a big problem in America, and you'll be more profitable and you'll have higher conversion rates. Just Excellent. Check it out in comments.
Yeah. And Alex is encouraging people to ask questions. And I had a question about, Dave flipped off his camera. But I was going to ask, I see that Alex.
I'll take another question, Rob.
Alex has a different model of t-shirt, Dave, of the same t-shirt that you're wearing. I see you went with the full collar. Alex has a different model. So
My shirts always come missing part of the neck.
Yeah. And I like the neck covered up, you know.
all right. Well, let's go on to the next slide, Alex, because
All
you
right.
do getting back to the economy here a little bit with this next slide in terms of questions that we received prior to the actual session today. And for a while there, the Federal Reserve was, and still to a great degree, the Federal Reserve was viewed as being behind the curve in terms of trying to head inflation off. There was a lot of talk about inflation being transitory. And when the Fed started talking about raising rates, there was a conversation out there that I would hear about just the Federal Reserve presidents discussing raising rates or potentially raising rates in the future may have the desired effect. That has not turned out to be the case, of course, and inflation is up at, as I said earlier, 8 or 9%. One of the questions that somebody asked ahead of today's meeting was, have the higher rates had the intended impact that they were implemented for? Meaning, if it weren't for the increase in rates that the Federal Reserve has implemented, would inflation be even worse? And Alex, I think, is this a polling question, a yes or no?
No, this is really
for conversation. Well, I'm gonna throw this directly at the one PhD that we have on the call. Mike, do you think that they've had the effect that they the intended effect?
I do. The one thing that people have to remember about the Fed's actions is that when the Fed raises rates today, the full impact on the economy isn't really felt for 15 to 18 months. So they're raising rates today in an effort to bring inflation down over the next year and a half. And that can be frustrating, and it can also be challenging. And to your point that they were behind the curve, they missed this increase in inflation. They completely missed it. And if they had started raising rates earlier, they would not have had to raise rates nearly as much or had the disruptive effect on our markets that it's had. So as an industry, we should be cheering for the Fed to quickly respond to any signs of inflation rather than letting it get out of hand the way it has this time, because the cure is worse than the disease from a housing and mortgage market perspective. But they need to keep going. And what they're watching is consumer, business, market expectations of where inflation is going to be several years down the road. Those are showing that the market still believes the Fed will steer inflation back to 2%, which is their target. If that were not the case, you would see longer rates, like mortgage rates, go much higher. If the market lost confidence in the ability of the Fed to bring inflation down, longer term rates would go up. So we want them to be successful in this, even if there's some short-term pain from the increase in rates today.
Yeah, I would say that certainly the Federal Reserve and the Federal Open Market Committee meetings actions grab the headlines. But if I'm looking at it from a selfish perspective, they can do whatever they're going to do. But what impacts me immediately is when I go to the gas station and I'm paying, $6, $7, $8 for a gallon of, fuel, or I go to the local Mexican restaurant or Chinese restaurant and my 2 cheese enchilada platter, which last week was $8.99, is now $9.99. And so those are reminders that consumers are feeling. I go to the store and my 16-ounce box of Captain Crunch is now 15 ounces and the price stayed the same, or maybe the price went up $1 a box. And so I start looking at store brand cereal. And so I think that things like that have an immediate impact. And you're right, because it is important for people to remember that the Federal Reserve's actions, it's like steering an aircraft carrier, right? It just takes a while for things to really sink in, and for companies, for example, who are going to borrow money to build that new manufacturing plant are saying, oh, wait a minute, things are slowing down. Not only that, but our cost of funds is higher. So maybe we need to rethink building that manufacturing plant. And that trickles down to households as well. But I wanted to ask you along those lines, Mike, household balance sheets and corporate balance sheets to a great degree, even the US government's balance sheet is in pretty good shape. And a lot of homeowners have refinanced through the help of our industry into mortgages that are, 2.5% or 3%, who are in much better shape debt service wise than they were a couple of years ago. How much of an impact does that have on the consumer and the consumer spending?
Rob, you're exactly right. And that's why we've kept as our baseline forecast, that the coin lands on heads, right? And we don't go into a recession, because households are starting from such a strong point. The job market's starting from such a strong point. If you look at total deposits in the banking system, households have more than $2 trillion more in cash than they did in February 2020. So there's that buffer that your typical household can be able to lean on, even if things slow down a bit. Now, I worry at either side. For folks on this call, I would advise you to not look at your 401k balance, because it's just tragic these past couple of months, the drop in stock market values. On the other end, if you look at folks that are renters or perhaps some of your marginal buyers, we're starting to see credit card balances creep up again. So, some households have worked through some of that cash that they built up through the pandemic, are now starting to borrow again. So it's a sign of stress. And to exactly your point, $6 gas and, higher food costs up 10% relative to last year. That's eating into some of that household balance sheet. But in the aggregate, on average, households look great, and that's going to help us sort of weather this storm. But on either side, you're going to see people being more cautious due to everything that you were just talking about.
And Owen, along those lines, in terms of underwriting and in terms of programs that independent mortgage banks can offer those borrowers, given their strong balance sheets, are you seeing a shift by investors in terms of incorporating that into their underwriting guidelines that you have to adhere to? Or is it kind of been the same month in and month out in terms of they need this to qualify and these are the programs and so on?
Yeah, we haven't seen much change in the underwriting guidelines or what they're looking at for loans. When you see some of the fluctuations in the interest rate, I do think we've seen, just because of the way the bond market reacts and the types of mortgages that the bond market wants to buy, right? Or I'm sorry, that they want to fill the mortgage-backed securities with, right? They don't want mortgages that begin with a 6, because they have no idea how long they're going to last. They don't want high 5s, because a temporary spike in interest rates, and I buy a whole bunch of mortgages, and all those mortgages, 40% of my mortgages in this pool only last 11 months. That's not great for them. So, we're seeing that, those temporary spikes affect a lot of the pricing modules that have always worked, don't work anymore. But we haven't really seen a whole lot of change in the underwriting, other than, a consumer shift back to a little bit more of a government borrower than a conventional borrower. We are seeing, and I think that's just some temporary movements in rates, but we're seeing more government loans this year, which is the first time in a while that the government loan share has creeped back up.
Oh, and you having any luck doing ARMs?
Almost none. In independent, the ARM is kind of like construction lending. It's just a very difficult product for an IMB, with no ability to shelf loans. When you think about how mortgages are amortized, the return on an ARM is obviously greater than the interest rate that's offered. But, you know, loans that people think are going to last for 18 months or 24 months or 30 months, they just don't pay for them from IMBs. So we're now locked into LO comp, and obviously we have been for, my goodness, 14, 15 years now. LO comp is really has a stifling effect on an IMB's ability to do ARM products.
And let me just add something to what we were just talking about as far as in individual families and what people are going through. In the recent past, looking at lower loan amounts wasn't as exciting, wasn't as interesting for a lot of lenders. I would encourage that in this environment, it is so important to look at those lower loan amounts, because they're the ones that really need to make decisions, and they will make decisions much faster. Low to moderate income families, if they're getting into cash crunches, this is the time to really focus more. I would say twice as much on those lower loan amounts and those lower income families, because they're making decisions fast. It has a real impact on their business, inflation, on their business, on their personal income and the lifestyle they can and need to live. They may have gotten themselves in trouble. We know the debt is high. We know that the equity is high. So I would encourage everyone to consider putting a lot of focus on some of those lower loan amounts and not just overlook them because they're lower. So just keep that in mind, and you will see a tremendous impact on your business as well that way.
Yeah.
And Alex, I'd just add that's an area of the marketplace where, like Dave had mentioned before, you can really lead with education, and it is a total winning strategy.
No question.
Yeah. So Alex, maybe I know we only have 4 minutes left. Maybe you just go back to the screen with all of us.
Okay.
I think we've talked about rates a fair amount, and one of the questions that popped up here with 4 minutes left is non-QM. And I had lunch yesterday with somebody who's well respected in the industry. We happened to get together and we were talking about the non-QM side of our business, and I want to address that question. I know it's not really on the agenda, but I think it's on the minds of a lot of people, because with the QM versus non-QM split, you know, the non-QM segment of our industry, every year it seems like this is going to be the year for non-QM. This is going to be the year for non-QM. And then March of 2020 comes along, and suddenly non-agency investors, I won't say run for the hills, but some of them did. And so then they
I'll
come
say
back.
it if you don't want to say it.
Well,
somebody has to.
Yeah. All right. But some like ACC, they'll say, well, we didn't. But companies like Redwood Trust, you know, it's tough when you have $5 or $10 million locked in with a particular investor and they go away. So we start this year, 2022, saying, okay, this is going to be the year for non-QM. And then boom, boom, you know, Sprout and First Guarantee, known for non-agency, go belly up. And so I wanted to ask the panelists, you know, what's with non-QM? Will it ever have its moment in the sun? And I know that it's good to have, for a lot of lenders and a lot of originators, the ability to originate non-QM. But what are you guys hearing among your clients, and Owen, what are you hearing among your originators in terms of is non-QM, is it going to increase?
I mean, the originators definitely want non-QM products, because I do think there is a market for the make sense loans. But I think non-QM is problematic, because the second there's a hiccup in the marketplace, it retreats. You know, and the second there's a problem with what that loan might be valued at, the problem was different in March of 2020 than it is now, but the remedy is the same, which is their funding dries up. or I shouldn't say their remedy, but their Achilles heel maybe is a better way to say it.
Sure.
So I
liquidity.
just think that there's definitely a need for the product, but the foundation sometimes seems to be built on quicksand, and it's tough to have a lot of confidence in that segment of the market.
Yeah.
Yep. There's and I won't add much more than what Owen just said. There is a hunger for non-QM, what we hear, and then there is application of it. And so I think it's a necessity. I think it's important for everyone to know how to speak to it. But again, just like Owen was saying, is it applicable? There was a couple more. I don't know if you saw those questions, Rob, that just came in the Q&A section. That was pretty interesting. And then the 40-year mortgage question. I don't know if we want to get to those or not.
40-year mortgage. I don't know.
Yeah, that was
Mike?
somebody's asking if there's any thoughts on that. Have you heard about that, Owen?
I have not. I think that's a question for the good doctor.
Yes, the good doctor.
Well, I know 40-year terms are being offered in modifications, right? So as an ability to offer some payment relief. Unfortunately, with the rate increase, it's not helping as much as you might think. So on a new mortgage, Owen, that might be a non-QM loan, right? And I guess I think there's
Yeah, it certainly wouldn't be a qualified mortgage.
Yeah, so that's
Not yet.
we just talked about. And just in terms of numbers, I think we're expecting, $40 billion in non-QM this year in a market of $2.35 trillion, right? So it's just to keep it in context, so it's growing, we think, but it's still a relatively small component of the total.
Yeah.
It's
good. I know we've only got about 30 seconds here or 60 seconds, but to everyone's point, yeah, it's nice for originators to have down payment assistance programs, to have non-agency programs, jumbo, non-QM, housing finance authority, renovation loans, construction to perm, and so forth. So reverse more, a lot of companies have brought in reverse mortgage divisions. So trying to satisfy that consumer, going back to Dave and Alex's point in terms of what can we offer to really help a broad range of consumers that are out there that might not fit under the FHA, VA, Fannie, Freddie, umbrella. And I think that's very important. A lot of lenders are acting accordingly. Alex, I guess we've reached the end of our time here. Alex, do you want some last minute comments, or Dave?
Well, so Dave had to run. He sent me a note. He had something come up that he has to run, so he had to get out of here at the moment. However, I don't know if we can wrap it up just yet. There's some really good comments. I know you got to run, Rob, but there's some really interesting questions. I don't know if Mike, you have time, and Owen, if you have a few more minutes, because I love what Dylan is saying. I don't know if you guys saw some of the comments from Dylan about the bundle. Love that. That's been a conversation we've had here, and we're talking to some of our banks about bundling auto and mortgage, which is an interesting concept. Some people are talking about, what next time we're talking about in the metaverse. Owen is like, I'm out. That's it. I'm not selling mortgages in the metaverse.
I'm not technically savvy enough to get into the metaverse, but I'll do my best.
Not yet.
Yeah.
I think overall, if we are going to wrap it up, there was also a good question. I don't know if Mike, you have a chance to answer Chad's question about the FHA in the Q&A section. I think that might be cool for you to answer for Chad. There's some great questions.
We're certainly watching that MIP closely, but no news as of now, but something we're watching really closely.
Okay, so the question that Mike just answered, so for those that didn't see, is there still discussion that FHA will lower the upfront MIP? And the answer is watching closely, but no news yet. So wanted to make sure we got that answer for you. Look, I mean, we've really covered a lot of important topics. We could probably keep this line going for another hour, and we have a lot more questions. But most importantly, it is talking to your customers, right? Treating everyone as if you truly want to help them, not just want to do their loan. Education, information, getting the intelligence you need on your customer base so that you can be a guidance system for them and not a reaction to what they might be interested in. And so, as Dave mentioned, through education, information, education, presentation, focus on all those things. There's some things that are out of our control, like we talked about weather and what that could do for insurance and other things that pull on the purse strings for the consumers. But we as an industry have done so well and need to continue to lean in to the opportunities that we can offer. But as Owen mentioned, and as we said now for fifth or sixth time, education and information. Listen to your customers, guide them, and make sure you are one of the people that talk to them, right? If there is no narrative created, they will find a narrative that suits them. So when you have a chance to talk to your customer, doesn't matter what it's about, if it's relevant to them, that's what they need to know. They need to know that you're in their corner and then you will be there for them as things change, not just in the market, but for them. And you are good stewards of the financial industry that way. So that would be my thoughts. I don't know if we can get some closing thoughts from the rest of the panel.
My only closing thought is, when you get back to the title of the seminar, it's about a rising red hot rate environment. I hope Dr. Frantantoni's prediction of 5.2 at the end of the year is true and we start to drift down. When I was getting dressed today, I thought about channeling my inner hope, so I wore my Detroit Lions tie. I don't know if you guys can see that or not. We're terrible at football, Lions fans, but we're great at hope. So I hope you're right, Mike.
Oh, you got somebody that commented, "Go Vikings." Uh-oh. Oh, no.
We'll do our best this year to increase the Vikings win total.
There you go. Any final thoughts, Mike?
Oh, just good to be with everyone. Appreciate the opportunity. If you ever have questions about any of the data or forecasts we're putting out, please reach out. Happy to talk with anybody that was attending today. Appreciate the time.
Awesome. Thank you for being here. And Rob, thank you for being here. Owen, everyone. Audience, you guys were amazing. Your questions were fantastic. We'll have to do this one again because this got so much engagement from you guys and so much value. Thank you so much, everyone. Love the thumbs up. There we go. Here, I'll give you guys a thumbs up too. I'll give a very special thumbs up to everyone.
I was looking for Myrtle to make a guest appearance, but she's out mousing for the folks who wrote in, "Where's Myrtle?" So she's not trying to earn her keep. Well, Alex, thank you for having us.
Yeah, my pleasure, guys. Thank you so much, everyone. Enjoy the rest of your weeks. Take care.